You're listening to an iHeart podcast.
Trading at Schwab is now powered by Ameritrade, bringing you an expanding library of education with even more ways to sharpen your trading skills. Access new online courses, insightful webcasts, articles, engaging videos, and more, all curated just for traders. Plus, guided learning paths with content designed to fit your unique interests. No sifting to find exactly what you need, so you can spend your time learning to trade brilliantly. Learn more at schwab.com/trading.
When you're with Amex Business Platinum, going the extra mile for your business pays off. With 5 times membership rewards points on flights and prepaid hotels booked through AmexTravel.com, you can earn more points to help grow your business. And with access to more than 1,400 lounges globally through the American Express Global Lounge Collection, including the Centurion Lounge,
can I get you a refill?
You can stay fresh wherever your business travel takes you. That's the powerful backing of American Express. Terms apply. Learn more at americanexpress.com/Amex Business.
Bloomberg Audio Studios. Podcasts, radio, news.
This is a breaking news update from Bloomberg. Instant reaction and analysis from our 3,000 journalists and analysts around the world.
The chairman of the Federal Reserve wrapping up the main news conference, the press doing their best to make that interesting, the chairman doing his best to make it boring, and I think he was fairly successful. Your equity market this afternoon looks like this. Equities positive by just 0.1% on the S&P 500. In the bond market on a 2-year, 10-year, 30-year, we look like this. On a 10-year maturity, yields lower by a single basis point, 427.91. The risks have risen, the risks have not materialized. The Fed Chair Jay Powell says we're well positioned to wait.
We don't think we need to be in a hurry. We think we can be patient. We're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low.
So they are going to wait to see the outcome of trade talks between the United States and China. Wait to see if this economy breaks one way or the other.
Why don't you just read Moby Dick for an hour and a half? I mean, honestly, if you want to know how the Fed looks when they filibuster, this was it. Ultimately, I thought that line was interesting, that the cost of waiting didn't seem that great. Some people, Neil Dutta, might disagree with that, but this right now is their stance. It is in a good place, and they did not give any sense of exactly what it would do to tip their hand away from that.
His speech at the Economic Club of Chicago repeated in the news conference this time around. If current trade policy is sustained, it could mean higher inflation. It could also mean lower growth. Our job, we have an obligation, Tom, to anchor inflation expectations.
The obligation is there, and of course the reach out is to when will they do something. There's a lot of heated debate. Neil Dutta sent me a note here from Renaissance Macro. He's scathing, is the only word I could come up with, scathing about their delay here. As you mentioned, Andrew Hollenhorst with a view, and then you go all the way out, dare I say, into next year. The dispersion here is wide. I just want to point out that if he had read the cliff notes of Moby Dick, like I did in college, he could have pulled it off.
Oh, yeah, in an hour and a half.
No mention of transitory this time around. Short-lived or short-lived.
Yes.
Is the new term for the chairman of the Federal Reserve.
Yeah, in the sense that they will get clarity as time goes on, and right now they have none, but it will be made apparent to them as things settle into place. This idea, though, that right now the economy is still relatively healthy is one aspect that I think maybe is going to become challenging in a month's time.
Let's get to the conversation. Joining us now, the former New York Fed President Bill Dudley. Bill, thank you for joining us, sir. They clearly face a range of risks, which, as the chairman says, have not yet materialized. Can you walk us through how you think they've responded to the risks they face and what you make of that news conference from Chairman Powell?
I don't think the news conference is surprising at all. I mean, the Fed is not really sure where tariffs are going to land, which is important. And when they land, they're not really sure what the consequences are going to be on growth versus inflation, and which side they're going to miss their mandate by a greater degree. So I think I was expecting him to say something pretty similar to this. And if I was in his shoes, I would have done exactly the same thing.
I thought the most notable line was the cost of waiting to see further data seem fairly low. Do you agree with that? Do you think that the cost is fairly low of simply being parked on the sidelines at a time where a lot of people think that there are signs of a rapidly slowing economy?
Well, I think the costs are low relative to the risk of making a mistake. You know, let's imagine that the Fed cut rates dramatically because they were worried about the labor market, and then it turned out that inflation expectations got unanchored and the labor market held up pretty well. That'd be a big mistake. And so the Fed really wants to make sure that they don't go down that path. This is not just about the central scenario. It's also about risk management. Try not to do the wrong thing so that you can respond effectively as things actually unfold. So I think the fact that the tariff policy is not set is important. And the fact that we don't have any experience with a tariff shock of this magnitude is also important. So in that environment, it's sort of like, the Hippocratic Oath, do no harm to your patient.
Bill Dudley, part of your charm is you had a day job before the Fed job of actually trying to forecast out the economy. How would you frame that now? You've got the luxury of not being at Goldman Sachs. Can you look out 1 month? Can you look out 2 quarters? Can you model out a fancy McKelvey-Dudley jewel out a year right now? I don't think you can.
No way. I mean, I think the only thing we can say is that the economy, like Chair Powell said, is the economy right now seems to still be in good shape. I think the most important thing I took away from the press conference that people should take on board is the fact that don't take the first quarter GDP at face value. The minus 0.3 reading is all because of mismeasurement. It's basically they counted imports a lot better than they counted inventories. So there was a big drag from imports that was not offset by a big accumulation of inventories. And domestic private final sales, which he brought up repeatedly in the press conference, is really a much more representative measure of how the economy is doing, and it's doing just fine, rising 3%. So I think he put the weight on the right things.
I'd point out Jan Hasius with a 2% statistic for this present quarter, published, I believe, last weekend. Bill Dudley, how does the Fed communicate, given this mess that has been wrought? What do they do in speeches coming up? John and I were talking here as we were looking at PSG Arsenal about Jackson Hole. How do they get to Jackson Hole and communicate to the nation?
Well, you can only communicate to the extent that you actually know what's actually going on. So I think it's appropriate for the Fed not to overpromise or imply that they have some crystal magic ball that allows them to see in the future when the future is actually very cloudy. What I'm expecting at Jackson Hole, frankly, is the Fed to talk about their monetary policy framework review and wheel that out. And I thought some of the questions at the press conference on that were interesting, where Powell admitted that maybe QE could have been wrapped up a bit sooner. So I think they understand that there are some things that they can improve in the monetary policy framework. And so I think that's going to be the most interesting outcome of Jackson Hole.
Bill, we've spent a lot of time speaking to Fed watchers on Wall Street, and they've all said a similar thing, that this time, because of the constraints, they might have to act late. They won't be able to act preemptively. And I guess it's important to understand his definition of being late, because there was this really interesting moment in the news conference, and I'd love your thoughts on it. He looked at the cutting that they did last year, 100 basis points of rate reductions, and said the Fed was a little late to start cutting last year. Just what is the definition of late on the FOMC?
I think late is when you realize that the risk on one side of the mandate have become very predominant. So if the fact is you're only cutting at that moment means that you're probably late, because the risk have really accumulated on the employment side of the ledger. And that's what happened last summer. The unemployment rate went up pretty quickly, and the risk of the labor market sort of unwinding in a bad way increased. And the Federal Reserve was pretty slow to get off the mark, and that's why they ultimately cut rates more quickly than expected. They delayed, and then they cut more rates quickly than expected.
I think that caught John's attention, and it caught mine as well, because some people disagreed and said maybe it was proactive in a way that led to the increase in longer-term benchmark yields, this idea that maybe actually there was more strength than expected in the underlying economy. I just wonder what that means going forward about that 2% inflation target if we're still not back there. If we did see something of a firming up of the labor market, and yet that still is the assessment from last year.
Well, I think there's two things that are relevant going on. Number one, the monetary policy may still not be as restrictive as the Fed thinks it is. I mean, the fact that the economy is still doing okay with a supposedly restrictive monetary policy in place, I think is meaningful, at least to me. And the second thing I think is going on that's really important that people aren't putting enough weight on is the labor force is going to grow much slower in 2025 than it did in 2023 and 2024. So the kind of payroll gains you need to keep the unemployment rate stable are much dramatically lower this year than last year.
There is this question going forward of what kind of pain tolerance would this Fed be willing to accept before they start to have the clarity that they need to actually make a move. We were talking with Rich Clarida just before the press conference, and he said maybe a 0.5% increase in the unemployment rate, something material that they could point to. What's your assessment that would actually provide clarity at a very unclear moment?
Well, I think Rich Clarida is broadly correct. If the unemployment rate starts going up rapidly, like we go from 4.2 to say 4.6, then the Federal Reserve is going to be thinking, boy, the labor market really is weakening in a big way. We are moving meaningfully away from full employment, and the risk in that environment is that we're about to have a full blown recession. The SOM roll didn't work well last year, right? The SOM roll, we triggered the SOM roll, and there was no recession, but that happened because the labor force was growing very rapidly, and so the rise in the unemployment rate was driven by rapid labor force growth rather than by layoffs. This year, if the unemployment rate rises rapidly, it'll be driven by layoffs.
Bill Dudley, let me throw in an audible then on that. Given a trade war, given the ballet in Switzerland here in the coming days, are we at risk of damaging the productivity that seems so successful over the last 24 months?
Absolutely. I mean, this is putting investment spending plans on hold. We are almost certainly going to have supply chain disruptions, even if we were to resolve this tomorrow, because a lot of ships from China aren't landing here at port, coming to port here, and then that means there's going to be a lot less time to replenish stores for Christmas. So supply chain disruptions to some degree are almost inevitable, and that's assuming that you switch things back, you turn the whole tariff thing off almost immediately.
Hey, Bill, appreciate your thoughts, as always. Bill Dudley there, the former New York Fed president. The Federal Reserve see it like this. The risks have risen to higher unemployment, to higher inflation, to lower growth, but the risks haven't materialized. And the risks are around trade talks as well. The President of the United States, in the last 2 hours or so, we've had a load of headlines from the Federal Reserve, but maybe the most important headline came from the President. The President said we're unwilling to lower tariffs to get China to the table. Now, the US is in negotiation mode at the moment, going into talks at the weekend.
Are we?
Talks about talks between the United States and China. And they can dial up and down the tariff policy whenever they like. You can't set policy in a moment like this because you don't know what policy is going to be on the other side of Washington.
You don't understand necessarily what the supply chain disruptions are going to look like. Let's say they don't lower tariffs in anticipation of these types of talks. China has said that is the only way to start talks. So does that remove the idea of talks from the table entirely, even though they might be seeing each other in passing in Switzerland? The key question here is, how do they start to game out whether this is really a pandemic-like supply-side shock or whether this is something entirely different that can get remediated in the near term? That is the difficulty that they are grappling with.
It is different. We've said it so many times on this program. I've heard all these comparisons to COVID. The difference this time around is you don't have to wait for the vaccine. The president has the vaccine. He can take the tariffs off, put the tariffs on whenever he likes. He's in control of the virus, if that's a good word to use. Probably not. No. But ultimately he is. If you believe there are comparisons to COVID, the president is running policy here. So not some runaway virus that we don't have control over.
Is he the chairman of the Fed right now?
I think he's in charge of what the Federal Reserve's about to do, without a doubt. And this is the problem for the Federal Reserve. Let's just say in a month these talks are fantastic. And the Federal Reserve cut interest rates by 50 basis points, 75 basis points, 100 basis points, because they thought these were the new rules of the game. All of a sudden, policy's offside. And guess what? They're about to deliver a big tax package down in Washington, D.C. as well. That's why this is so hard.
Fed Chair Jay Powell alluded to this, saying there are things that can be done, some things, we haven't seen them being done, but there are some things that could be done that could actually cause outcomes to be very different. Key question, and this is something that comes up in a lot of our discussions with analysts and economists, there is damage being done. It's not as if this genie can go back into the bottle so easily, and there are ships that are not going to get here, and there are already supply chain disruptions. So at some point, that is the reason why people are saying the pain is already being felt, the damage is being done. It's now just a matter of magnitude.
But a number of weeks ago, we had a but where Bessent and maybe Lutnick had to go to the president and say, you're offsides, fix this right now. And what? In 10 minutes, they had it fixed.
And that initiated the 90-day pause we have.
Yeah.
And the negotiations are starting. But if you're the chairman of the Federal Reserve, look, it's an industry to go after the Federal Reserve. We all partake. I understand that. We've been very critical over the years.
You do, John?
But I have some sympathy with the institution at the moment. I don't understand how you set policy for the medium term in a moment like this one.
I think that's the reason why the policy tool that is communication is now filibustering, because ultimately there is no communication that can be had at a time where there is no information, solid information that can be had. And so maybe we'll get Moby Dick.
My sympathy has limits, of course.
I would suggest
that.
the Fed is codependent on the president. The president's driving the dialogue right now. It's standard psychiatric work. They're codependent on the White House.
The White House is in the driving seat. Couldn't agree more, TK. Mike McKee was in the room. He's out of the room now. Mike McKee, welcome back to the programme. You said it multiple times, Mike, in the lead up to this. I don't have anything to add on that, Chairman Powell. And Mike, on a number of issues, he didn't have much to add.
No, he didn't. You've been talking about it. The Fed doesn't know what's going to happen. Nobody knows what's going to happen, so you can't make policy. But one thing I would add is that you've been talking about this as a supply shock, which it very well could be. But the Fed was also sending the message today that it could be a demand shock. And if there's a demand shock, it could be reflected in things beyond just the unemployment rate and the inflation rate. We could see people start to pull back on spending significantly because either the shelves are empty or because they think things are going to be bad. Maybe they listened to Jay Powell today talking about the elevated risks. So there's a lot going on, a lot of cross currents going on, and it really comes down to how does all this affect the consumer? And by that I also mean businesses, because as you reported every day, people are pulling guidance. They don't know what's going to happen. So at this point, the economy could go either way. The Fed's stuck in the middle, and really there isn't much to say about the Fed for right now, except that they're watching like we are.
Mike, you're a student of Fed history, and I wonder how much this has a parallel in recent history at a time when the Fed is just going to say uncertainty in 15 different ways and then sometimes the same way over and over again.
Well, I think there isn't an exact comparison, but what you might look at is obviously the pandemic, where nobody knew what was going to happen because we hadn't had this happen before. And so the Fed was stuck in a situation where it knew things were bad. It knew it had to do something. But how long did that have to go on, and how far did they need to go? That was the question that was never really decided, and we kept talking about for months and months. But the idea of we've got stagflation out there, but we don't know if it's going to happen. And if it does happen, we don't know how bad it's going to be or when it's going to happen. That I don't see any precedent for.
Michael McKee, for our international audience, brief us right now on, and you and I know the shadow FOMC, iconic at Carnegie Mellon and the rest. Tell us about the Trumpian shadow FOMC right now. Is there coalescing a beast that's going to send signals, send messages, critique Jerome Powell?
Well, there are a couple of different groups going on, you could say. The Shadow Open Market Committee doesn't really have a lot of critiques at this point, other than what we were talking about earlier, the Fed's mission creep, the question I asked him. There are people who are contenders for the Fed chairmanship when the president finally makes a decision who could be having things to say. Kevin Warsh talked last week, the week before, about that. But really, the opposition or the people who are going to raise the question are in the administration right now, because the president wants to influence the Fed. He can't really do it, but he wants to. So there are going to be other people who are going to pick up on this stuff and talk about it. Scott Besant's been asked about it. He was asked about it today. They want the Fed to lower rates, but I think Mr. Besant knows, even if Mr. Trump doesn't, that the Fed can't move right now because they don't know what Mr. Trump's going to do.
Mike McKee, appreciate the reaction. We'll hear from Mike throughout today on Bloomberg TV and on Bloomberg Radio. So we've had plenty of sympathy for the institution. It ends right now. Here's the criticism. It goes like this. I've heard it now from the previous Minneapolis Fed president, St. Louis Fed president, rather, Jim Bullard. I've heard it directly from Mohamed Al-Erian as well, that this Federal Reserve is only really entertaining one scenario. But you hear a lot of people talking about a wide range of outcomes, but emphasis matters at a news conference. And the emphasis with Chairman Powell keeps landing on stagflation without saying stagflation. And Jim Bullard said this, and Mohamed said it as well. What they don't entertain is the prospect of a good outcome, the prospect that the Chinese turn around over the next few weeks and say, you know what, we'll give you what you want. The Europeans do the same thing, and you end up in a situation where you have lower tariffs. And maybe you end up in a situation where you have a reduced tax rate as well. And perhaps by the end of this year, you're in a better position for both the risk assets and growth too. And you don't hear any of that when you listen to Chairman Powell, and I didn't hear much of that at all in the last 90 minutes.
There's a key question here. Is there a scenario in which they would have to hike rates? Is there a scenario in which they don't have to move at all because this is a soft landing in the same kind of way that they used to with no tariffs? There is a positive economic outcome that he kind of alluded to in passing, but it wasn't necessarily the main story.
Yeah, kinda, but not really,
but
right?
Not really.
Joining us now to discuss, Jeff Rosenberg of BlackRock. Jeff, I'll make it simple. Is this a moment to own bonds? And if so, where on the curve?
It's certainly a moment to be adding diversification to your portfolio, because the whole theme everybody's been talking about, and Powell answered in multiple ways, is we don't know, and he doesn't know, and it's heightened uncertainty. So you need more balance in your portfolio. Now, the subsequent question is, do bonds give it to you? And there I'd say you got to be more anchored to the front end of the curve. The back end has a lot of uncertainty. You got to look for alternative ways of finding diversification in your portfolio. And beta exposures are just directional. Is the market going up? Is it going down? Is it a good outcome? Is it a bad outcome? As Lisa was just outlining, it's incredibly uncertain. And so it's a time for diversification.
Jeff, this feels like in high school when someone really likes someone else and they keep talking about them ad nauseum and you feel like there's nothing else to talk about and you're kind of sick of the conversation, but you feel like you have to keep entertaining it. It feels like everyone's trying to get into the head of one person again and again and again, and is sort of exhausted by the end of the day. How do you rise above that and understand what's actually happening in the economy in some kind of way to understand which way things are turning?
Yeah, it's a good metaphor. It's a fun metaphor, and a tough question. And I think one way is to really think about it from a portfolio construction point of view of what am I exposed to in my portfolio, right? So if it's about one person and one outcome, that's kind of the antithesis to what we've all learned over the years of how to build a good portfolio. Don't put all your eggs in one basket. In this context, it is don't have all of your outcomes determined by that uncertain and unforecastable outcome. And so that's really about diversifying my sources of return. I've talked about it on this program before. Often all we talk about is the beta outcome, the directional outcome. And there's another good news story here for investors, which is all this uncertainty actually increases opportunities, but if you're investing not in directional space, but in the cross section. And so you're creating bigger winners and losers in the micro space. There's greater divergences and dispersion in the macro space. And so if you have strategies that are more about betting on the differences and not the direction, you can balance out your exposure to not just one person. That's a really tough outcome, but to hundreds of different outcomes. That's a better chance for success. And that's a way to pivot away from this kind of unipolar focus on that, popular person in high school.
Hey, Jeff, I see. I don't, is there anything else you'd like to add right now?
Jeff, thanks for entertaining that. Thank you.
You know exactly what I'm talking about.
Was this at a Friday night party?
Just pause.
I don't want to get too deep here, TK.
No, but you get the idea that it's just sort of exhausting. There's something more to say or talk about.
Everyone's exhausting. I'll take that from you. There's no question about that. Jeff, off your remit, what I'm seeing is a multi-standard deviation move in selected currencies. Where's your unexpected out there across equities, bonds, commodities, and particularly the depth of the currency markets?
Yeah, I mean, the FX move is really important here, right? And so, let's just kind of look at what's happened in markets since April 2nd is you've had this remarkable rebound in risky assets, equities, sub-equity indices, factor exposures, and we've kind of are above in many of those measures the April 2nd tariff day, Liberation Day announcement. The one exception, a lot of these boxes are the same, which one's different, is the dollar and the FX piece of that. And that's really talking about kind of the global impact here, and that hasn't been resolved because, are we going to be talking about deficit equalization or tariff equalization? The latter is a pretty good outcome to the earlier conversation. You could get lower tariffs. This could be really positive. But the former, which is what was the initial thrust of the policy announcement, is deficit equalization. That's very problematic, and it's problematic to the flip side of deficit equalization is a big collapse in the U.S. capital account surplus, and that's what you see on the currency piece. Yeah. That's the big surprise move. We got to keep an eye on that, and I think that's a really key development. Especially as we go through each one of these announcements on bilateral trade negotiations, you're going to look at the voting evaluation of those pronouncements in the currency markets. I think you'll get a good read on.
This goes to the heart of your whole discussion around diversification and balance. How much is that diversification and balance increasingly international as a result of that uncertainty around the dollar and the space going forward?
Yeah, I mean, look, that's a huge theme. You see it in the flows. You see it in the relative equity returns. It's partly what's reflective in the currency that you are seeing from a global investor's perspective, kind of a questioning of the overweighting that has existed in, say, equity portfolios because of the dominance of U.S. capital markets, right? You look at GDP versus market cap differentials, and you have a very big gap. The largest gap is in the U.S. And so that's one way of sort of thinking about where would the rebalancing occur. And the trigger for that is, again, this assessment. Are we going to push further on this policy towards deficit equalization? Then I think you're going to be looking more at equalization between market cap and, say, GDP contributions in the global cross-section.
John, the fiscal debate may get overwhelmed by the actual data of employment and interest rates back to the Fed and all that. But I would go back to what you and I first talked about decades ago, which is Euro-Swissy. And the fact is you have strong Swiss right now. And as Jeff alluded to, anybody in equities, including all our listeners and viewers in the stock market, don't forget to monitor foreign exchange each and every day. The Swiss franc is talking right now.
And these central banks will have a decision to make, how to respond to some of these shocks. And I think it's clear the kind of decision they're making so far. Lisa, we've talked about it. The ECB reducing interest rates. The Chinese coming out, reducing interest rates. The Federal Reserve doesn't really understand the nature of the shock yet. The rest of the world has decided it's disinflationary. Maybe they have the capacity to reduce interest rates in a way that the Federal Reserve does not. But we've talked about this a million times. Trade talks, things can change from hour to hour, never mind day to day. It's only a few hours ago we read a headline from the President of the United States that said he wasn't willing to reduce tariffs to engage in negotiations with the Chinese. And then we have reporting moments ago that says the President is ready to rescind global chip curbs. Now, this is sort of one versus the other. Every single headline moves this market one way versus the next. The Federal Reserve can't behave that way. It can't reduce rates 25 minutes ago and then hike them the next. That's the problem they've got at the moment.
In fairness, a lot of people feel like they can't live like this right now. A lot of traders out there are saying, what's the point? I mean, you see that whipsaw in the NASDAQ in particular. This is something that NVIDIA has wanted. There is this tension between the fast-moving headlines of a tweet or a truth or a statement with the real economy and companies that have to make longer-term decisions. And as an investor, especially where speed was your friend, how do you deal with that in a very different backdrop?
Jeff, are you tired of this yet? How are you feeling?
Look, we're feeling great. This is creating a lot of opportunities if you know where to look and reweight your sources of returns away from the stuff that's impossible to forecast, right? And so, like in this last conversation, this is sort of in our kind of systematic framing. It's like momentum signals versus reversal. Momentum is a really tough strategy right now. Reversal, much better. For exactly the description that you're just talking about. One day it's one headline, even within a headline, within a day, the headlines are reversing around. So that creates opportunities if you're weighting your sources of returns to the right environment. And it's just kind of like recognizing, look, the easy momentum macro trade of the post-COVID environment is not the trade right now. It's much more in the cross-section, much more reversal. That's where you can find some opportunities. And if you're trying to predict, what the next trade headline is going to be, that's going to be a very frustrating place to be.
Yeah, good luck to you. Never mind within a day, within the hour. Jeff, thank you, sir. Jeff Rosenberg of BlackRock. The latest reporting from the team here at Bloomberg. The Trump administration planning to rescind Biden-era AI chip curbs, according to people familiar with the matter.
You look at NVIDIA shares, they're up more than 2% on this news, and it makes sense given how vociferously against this they've been. This goes to the question of what is the ultimate goal of some of the tit for tat in the trade war that is between China and the U.S. Is it just complete decoupling when it comes to tech? Is this trying to tweak the rules? Confusing.
Hiscox Small Business Insurance knows there is no business like your business. Across America, over 600,000 small businesses, from accountants and architects to photographers and yoga instructors, look to Hiscox Insurance for protection. Find flexible coverage that adapts to the needs of your small business with a fast, easy online quote at hiscox.com. That's HISCOX.com. There's no business like small business. Hiscox Small Business Insurance.
It's almost Mother's Day, and you can now get anything you need delivered with Uber Eats. Well, almost anything. So no, you can't order a relaxing shower, but some beautiful flowers, you bet we deliver those. A bird bath? No. A bath bomb? Absolutely. It's no to a chocolate lab, but yes to some chocolate truffles. So whether it's a last-minute gift for Mother's Day, fresh groceries, or food from your favorite restaurants, get it delivered today with Uber Eats. Order now. Product availability varies by region. See app for details.
You're listening to an iHeart podcast.